Today is Tuesday, favorite day of the week, podcast day. Jeff of all trades. Today's show, Stephen, my main man, premier lender of Fountain Mortgage. Fountain Mortgage. At your building, do they have a massive fountain in front of the building? So we're going to recap. I asked Stephen if he had a big fountain because the company name is Fountain. Okay, we're good. Oh, I just punched my mic. That's what you get for being in my way. Okay, so all sounds good. You sounded good. Stephen was saying that in Kansas City, Fountain Mortgage has installed or has dedicated a lot of fountains to Kansas City because they want fresh water flowing for them clients, for them citizens, and their dogs. So if their dogs are thirsty, bam. And if they want to take a bath, sometimes that's not a bad idea. But that's not what we're talking about today. We're talking about something I talk about every day almost, and on the weekends multiple times. As you know, I do a lot of open houses and I show a lot of homes when people are not working, not when they're working. And when are they off work, Stephen?
They're off work when you're working.
When are you off work?
Never off work.
We work when people are at work and we work when people are off work. That's why you're my main man, you're my main lender. And the thing I talk about, and I try not to rush into, I try to gently open the door to this subject, is money. Money. That green stuff. But it actually doesn't come in money, in cash. It comes in a wire.
Hold on, Jeff. Hold on. I got something for you.
What's up?
What do you say? What are we talking about?
Money. We're talking about money, cash.
Hold on. Check this out. I got it on cue.
Question?
I got it on cue for you. Hold on for a second.
Money. But it actually doesn't come in money, in cash. It comes in a wire.
Hold on, Jeff. Hold on. I got something.
What's up?
What do you say? What are we talking about?
Money. Listening. What are we listening to? Okay, going back to money.
What's up? I got it on cue. I got. Go ahead.
Turn the volume down a little bit.
Go ahead.
Okay. Money. You need money to buy a house, not just your money, but the bank needs to give you money. We're going to talk about what your money needs to be, but we're going to talk about the money from the bank. Every single person, 95% of them, not all of them, but a lot of them, I talk about loans, and they think that there's a lot of loans. So we're going to jump right into it. I have a picture here. We're going to talk about loans, and we're going to talk about the one that I always recommend getting because I want you to have a low payment, and Stephen does as well. Because if you have a low payment, that means you can buy more, or you can buy, period. So when someone walks into that, I'm just going to use as an example an open house, and I talk to them and I ask them how I can help them, how can I assist them, and we get to that process of, okay, well, what do I do? What's the first thing to do? We need to get a pre-approval letter, not a pre-qualification letter. And why do we not want to get a pre-qualification letter, Stephen?
Because pre-qualification doesn't necessarily mean that I have looked at their documents and confirmed they've got money and confirmed that they have a job, that is a job that we can count. So we want to go with a pre-approval letter where we reviewed all the documentation, the credit report, we know how much money they've got, and we've run them through the underwriting process.
Exactly. A lot of people don't know what that is. A lot of lenders, well, not a lot, but there's some lenders that don't know what that is. And on my listings, I'll get a pre-qualification letter. And I say, heck, no, we won't go because that's not right for my client. Because I know that doesn't mean it's real. I can get a pre-qualification letter right now to buy $1 million house. And Stephen will be more than happy to give it to me. But it's not real. Because once he looks at my information, he's going to realize that I can't buy $1 million house unless I put his social in. And then I can buy $1 million house.
Yeah.
That's the point I'm trying to get at. So we're going to talk about the types of loans. There's only 4 of them. And I'm going to throw a picture up there right now. Boom, look at that. There's a picture. Stephen, you'll get it in a second on live. But the picture shows an FHA. It doesn't have anything to do with first-time home buyers. It just is Florida Housing Administration. You should, see it on the live screen, on your live stream.
Yeah.
Not yet? Okay, it's on mine.
Yeah.
It
There it
there it is. So
is.
it just means Florida Housing Administration. It doesn't care if you're a first-time home buyer or second-time home buyer. You cannot have two of them when they're close. There's some guidelines that you can have two, but there's some restrictions. The second type of loan is a conventional loan. That's the one me and Stephen really try to get you. That's the one that you want. We're going to go over that in a second. The third one is USDA. USDA sounds like meat, like or food or something. USDA, but it's agriculture. It's farmland. It's orange trees. It's in an area since Florida, Central Florida, north south was mainly orange groves and growing farming. USDA is like a VA loan, and VA is the last one. USDA and VA have no money down. I can buy a house with no money down. It doesn't mean that you don't need closing costs. You're going to have money for closing costs unless you get it negotiated. But there's no money down. And do you break into a little bit more about USDA? Besides, I don't see a lot of them. There's only one county still doing it. Stephen, tell us a little bit more about that.
Yeah, USDA loans, as Jeff mentioned, Department of Agriculture, you can get those with no money down. You've got to have a specific area. It is specific to the area, so you couldn't necessarily get one in Orlando. You may need to go out a little bit. But it is area specific. It's income specific. It looks at the household level, which is very challenging sometimes. Everyone in the household, their income takes into account, regardless of whether they're working or not. But it's a great loan, no money down. The rate's just a little bit higher, but there's no money down, which is great.
And as Stephen was saying, there might be some in Orlando. I haven't seen any. It's hard. Orange County, it's the county. Orange County, the zip codes, they go by zip codes, and then they say if this area is eligible. There's still USDA loan properties out there that you can get a loan for, but they're hard. I've done 3 of them. I've done 3 in my lifetime here with being a realtor, and all 3 were in Orange City, Florida, which is Volusia County, right next to DeBary, right next to Deltona. DeBary doesn't have any. Deltona doesn't have any. But Orange City seems to be, every year they keep saying, okay, we're not going to kick it. We're not going to kick it. But so we won't spend too much. We're going to not talk about that anymore because it's not there.
Just two things on USDA. It's
Okay.
no money down, right? It's no money down, but you got to remember, first of all, it requires a tighter debt ratio. Scores have to be a little bit higher than you would need for like FHA. And oftentimes it requires reserves. And those reserves are calculated on an average daily balance. So if you have like no money in your account and you go throw like $3,000 to show some reserves, that may not necessarily get it because it looks at the average daily balance, which is looking over the course of 30 or 60 days. So just got to understand that it's looking at average daily balance, which is not like normally I need reserves, just put some money in there and it's there. So there's just a couple things I wanted to point out about USDA loans.
I didn't know that. Moving on. I always ask people, were you in the military? Were you in the military? I almost was in the military. And yes or no. Let's say they say yes. If you were honorably discharged, you can use your VA loan. Now, there is a fee that no one really talks about on the lending side. Well, it's the government. They charge a VA fee. But if you are a disabled vet, correct me if I'm wrong, Stephen, if you're a disabled vet, you get that fee waived.
That's correct.
And that fee goes into the VA loan. It's not in the closing cost. So VA, and also what I love about VA is no PMI. What is PMI, Stephen? What is IMP?
PMI, IMP, MMP, IMP, it's private mortgage insurance, right? It's insurance that typically most of us have to pay unless we put down 20%. Most of us have to pay that for the life of the loan, right? So with VA, they don't have any PMI. There's no PMI. There's no mortgage insurance. There's nothing for veterans. And that's a huge savings on a monthly payment. And it's a fantastic benefit. VA loans are some of the best loans, and that's why. No PMI, no money down. You can roll some of your closing costs into the loan, and then the rates are pretty much the best you can get out there.
Great rates. The rates are different. People think that the interest rate is the same for all the loans, and they're not. The VA can qualify for a different rate, conventional, and so on. So that VA loan is a government-insured loan. If you do not pay it, the government will pay it back, Uncle Sam. But there's no mortgage insurance. That's the huge plus. So when someone says that their VA, majority of the times, not all the time, they don't want to put any money down because they don't have to. They're like, I don't want to put any money down. I just want the loan to be 100% financed. Sellers don't always like that because they feel if they don't have any money down, they're going to ask for closing costs. 8 out of 10 times, they ask for closing costs. So the buyer, the client, the buyer, and this is for realtors to learn as well, the buyer says, I'm a vet. Thank you for your service. I want to use my VA loan, $300,000 house, $300,000. I don't want to put any money down, Jeff. You're going to have to put an escrow to show that you're serious, at least $3,000. I want to get that money back, though. Okay, we can do that. I don't want to pay any closing cost either. I don't have any money. And you don't need a lot of money in your savings account. Am I correct, Stephen? Is there a certain limit, or is there?
No. Everybody's different. But typically, you don't necessarily have to have a lot of money in your bank account. I mean, sometimes it might come back and ask for reserves, but most of the times it's okay. It is important to know that VA is very flexible with debt ratio. So whereas FHA may cut you off at 56.999% debt ratio, on VA, in most cases, you can go up to sometimes 60, sometimes even 70% debt ratio. So everyone's individually different, but VA would allow for it to go a little bit higher. Certain investors will cut it off lower, but VA has a lot more liberal debt ratio standards and allow you to go up. But they also have something called residual income. So VA looks at your income and they look at where you're going to live and how many people are in the house, and what your square footage from a maintenance standpoint is, as well as what your taxes are. So they calculate truly a cost of living, and can you truly afford to live, even though you will be allowed to go up to a 60 or 70% debt ratio. They do have another category, they call it residual income. They want to make sure that you can truly live. So while they allow you to go higher in your debt ratio, they also will have a check and balance with that residual income to make sure that you're truly not expending your capabilities.
I didn't know that they go that far. When you say 59 to 70% debt ratio, you mean that with all the bills, the mortgage payment, the car payment, anything going to the creditors, you can actually get up to 59% and have, what is that, 41%? Is that 40 or 40? 40. You can live off of 40%. So you need 41% to live off of and still get the loan, which normally you need 45% to live off of, correct?
Yeah. Normally you would need somewhere right around actually 43%, minimum with FHA. 50% max or minimum on conventional. Probably 67%, 66% or 56% with USDA, whereas VA will let you go a little bit higher, a little bit lower. But again, that's where residual income comes into play. So sometimes someone could have eligibility. They are eligible for no money down, but can't qualify because the residual income number is something that they can't meet, because the VA does not want you to be house poor, because they know if you got so many people in your household, those people have to eat. You got to feed those people. So they don't want you to be house poor to where you can't make your house payment.
So if you're going to buy a house and you have your family living with you, do not tell the lender that they're living with you. Is that what you're saying?
No, not at all. You got to disclose everything on the application.
Oh, just checking. Just checking. I want to go into that debt ratio, and then we're going to talk about my favorite loan, conventional, because that's what I really want everybody to get is a conventional loan. I wish I would have got one. Is you said 50 to 60% on conventional 50%, meaning that you have to, your bills and everything going to the credit bureau cannot exceed 50% of your income, and you have to live off of 50% of your income. Debt to DTI, debt to income, that's what it is. The lender looks at what you're paying now, and you need an address to really figure this out correctly, right, Stephen? You need an address, so you have your taxes, and the next picture is going to be a monthly payment, how it's broken down. But what you're saying is that debt to income, which a lot of people don't know, is something that we're not talking about. It's not taught in schools, obviously, is your creditors, your credit card, your house payment. You take that amount of money. You take, let's say you make $5,000, $6,000 a month. And let's say your debt to income, not your phone bill, not your health insurance, just the stuff going to the credit bureaus is $3,000. So your debt to income would be 50%, which is good because you can which is good because when you get into 55% is when it gets hard, correct?
Yeah, you can't qualify, so conventionals don't cut you off. And some banks will cut you off at 40, some will cut you off at 45. But Fannie
off at 45% debt to income.
Yeah, some will cut you off at 40, some will cut you off at 45%. Fannie will allow you to go up to 50%, but not all banks will do that. Some will cut their risk and they'll cut the debt ratio off. That's why you have some people that'll say, I couldn't get qualified. Well, that's only because the bank they went through didn't want to go so high on the debt ratio and cut them off at 40 or 43 or 45%. So it's not necessarily always a no. It's just maybe you need to try a different bank if you can't get qualified.
And you represent a number of banks, not just one bank.
No, I only represent one bank. Fountains, I'm a correspondent lender. We have certain investors that we work with. So we have many investors.
Okay.
Yes.
We're like that one bank might only have one investor, and that one investor says 40%. That's it, and that's the best they can do. And I don't want to we'll just you know what I'll say it. There's some big banks out there. I have an account with them, Wells Fargo. I met a client over the weekend. They went and talked to the lady at Wells Fargo because you go in there every week, you cash your check, you talk to them. The thing about Wells Fargo, nothing against them, is they're a big bank. For one, they're not open on weekends to talk to about lending. You're not talking directly to the lending person. That might be different. I'm not trying to throw them underneath the bus. That's just what I've seen in the past. And the loan that the options that they can give you money on seem to be tighter, where if you have someone that has multiple investors, those are the ones that you can get a loan from when you couldn't somewhere else. So that's good, having more options in your pocket.
Absolutely. The magic happens when you have options and choices, right? That's where the magic happens, because in some situations, that person may need something that another investor might be able to offer them. So, yeah, but the true magic happens on the weekends and after hours. When those bankers go home, that's when people start to shop and look for houses and think about it and really put their mind on it. And that's when you need to be available to help out borrowers and realtors. You got to be there after hours. You got to be there on weekends.
After banker hours. That whole, I wonder where that phrase came from. Who sat there and said, banker, I work banker hours, or is it like banker hours, that saying, banker hours? I wonder who came up with that, because the banks only open 9 to 5 and 9 to 6 on Friday, and then 10 to 1 on Saturday, and they're closed on Sunday. I always wonder where that came from. So on the screen now, Stephen, you can look on your live stream. That's the monthly payment breakdown. I apologize if they're spelling. I can't spell to save my life.
Okay.
Grammarly is the best thing for me. But monthly payment. So I took the loan away. We want to try to get you a conventional loan. The reason why is because I want to get rid of this PMI. I don't know if you can see this you might see it here in a second. I want to get rid of this PMI. The PMI adds money to your payment, like we were talking about earlier. On the screen, you're going to see a monthly payment breakdown. You have your homeowner's insurance, you have your principal and interest, you have your taxes. And if the HOA is monthly, the HOA is going to be in that payment. The HOA is going to be in your monthly payment, but a lot of times they're not, right, Stephen? A lot of them are semi-annually, quarterly, annually, and when they're like that, they're not in the payment. They're not in the payment, so that's good. But that last one, mortgage insurance, PMI, that don't need to be there. What is it doing? It's doing something you don't even, it doesn't need to be there. Like, oh, where'd it go? Is it coming back up? What'd you do? No, I wanted to stay. Okay. Yeah, sorry about that. My sound booth person was doing something. That PMI adds more money to your payment. And what me and Stephen always talk about is don't look at the amount of the don't look at the amount of the loan. A lot of people think that they need to base it off of I can only afford 400,000. I can only afford 450,000. The truth of the matter is a $400,000 and a $440,000 loan could have the same monthly payment. The same monthly payment, especially if it has higher taxes, especially if it has mortgage insurance, and if the HOA is a monthly high payment. So, Stephen, go into a little bit of that. Am I on the same track? Am I on the right track there?
You are absolutely. So I'm sending out a post right now to talk about, how do you eliminate PMI? That PMI can be a sizable amount of your monthly payment.
200.
And
yeah, it's like at least $200.
Yeah, it could be depending on the size. The loan sizes that you do, they're pretty much in that range. But like if we look at a person right now who has PMI on, let's call it maybe a $200,000 house, and they're going to go with a conventional loan and they're going to put down at least 10%, you could buy out the PMI without putting down 20%. That person can put down, probably 8 to 10% and buy it out. In this case, I ran a scenario. This guy could buy out his PMI for just $1,370.
At 10%.
So,
putting
yeah,
10%.
At 10%, yep.
Why can you put down any lower amount? Does it have to be 10%?
Well, it's got to be probably what has to happen when you're buying out PMIs. There's a certain threshold for a loan to value that you have to stay. There's a max, and you can't exceed that.
Okay.
And so you got to play around with the numbers a little bit. Sometimes it's 7 or 8%, but typically it's got to be somewhere around 10%, a little bit less sometimes, in order to get a quote to allow you to be able to buy it out, because conventional and all of the government loans have something called qualified mortgage. And the qualified mortgage is basically a compliance check to make sure that the fees are not too high for borrowers and they're not paying too much in fees. And so when you get below 10% on a conventional loan and putting it down, sometimes you have issues with the compliance check. So, but in this case, it's a beautiful thing. So a person putting down 20% is the normal way people get rid of PMI. But you don't have to put down 20%. You can put down probably 8 to 10%, and you can buy that PMI out front. Like in this person's case, it was $1,300 on a $200,000 house, where he can pay $1,370 at closing and not have it a part of his monthly payment and never pay PMI at all. And that's without putting down 20%. A lot cheaper than putting down $40,000, right? A lot cheaper.
That's a lot cheaper. And I'm gonna recap that. I just took a drink of my sparkling water. This is not an advertisement for sparkling ice water, but if you would like me to advertise, I drink it. I don't even know what's in that cup, but this is pomegranate. I'm a huge fan of sparkling ice water. If you want to reach out to me, see the link in the bio. Okay, so PMI allows you to buy more house. PMI allows you to get a lower payment. PMI are the stories that you have friends that got this insane payment with a $300,000 loan. What Stephen is saying is if you can put 10% down, sometimes 8% down, instead of paying $200 to $300 every single month for 30 years, you can buy out that PMI immediately. And you're like, wait a minute, I don't have to put down 20%. I only need to put down half of that, 10%. And on this scenario, it's only going to cost me $100 or $1,500. Why doesn't anybody tell me this? Why doesn't anybody advertise this? And the reason why no one advertises that is, why is that, Stephen?
Well, I mean, some people don't know how to do it. Some people just don't know.
Does lenders make more money when there's PMI in the loan? Does someone makes money on that? Because that PMI is that's insurance for the loan, but FHA has PMI, plus it's a government insured loan. So isn't that two insurances?
Well, no, because FHAs is they're the same thing, but you have different loans. But the reason why most people don't know about that is because a lot of loan officers don't know about that. They don't know that you can eliminate that PMI with that option in the conventional loan. They only think, like most borrowers think, that they have to go with 20%. So most of them don't know. You got to understand, a lot of people only do FHA loans. A lot of people only do VA loans. Some people only do, certain loans, so they don't know some of those things that are in there with conventional. Conventional was designed to make things a little bit easier because you don't have as much dealing with the governmental stuff. You're dealing with private investors. So some loan officers just don't know that you can buy it out without putting down 20%. They just don't know it.
We're dangerous because we know this stuff, and they're not dangerous in a good way. Now,
Right.
but sometimes, Stephen, clients have to get an FHA loan, and that's okay because it's about getting you in the door.
Right.
And sometimes you can get an FHA loan, buy down the interest rate, and it's the same payment as a conventional loan without the PMI. I'm going to say that again. There's two different types of loans. Sometimes you cannot get a conventional loan, and a lot of times it's because of the credit score. Your credit score really needs to be over $700. It really needs to break 700. But let's say it breaks 655, and you can't get that conventional loan. But you're like, okay, well, I do have some extra money, Stephen, because your fees are so low, and Jeff negotiated 3.5% for closing costs. What can I do? And Stephen, what do you do?
Yeah, well, we can take some of that closing cost to use it to buy the rate down and get them a super low rate. FHA's rates are going to be a little bit better anyway, but we can buy it down. We can do a discount point, buy the rate down to get them into a position where they've got a lower monthly payment, than what they would ordinarily have.
Wait a minute. Did you say that FHA rates, interest rates, are better than conventional? What determines that? Like who does
Yeah,
it?
so those loans are insured, right? They're insured by the federal government, the government services entities, FHA, right? The Federal Housing Administration. So they insure those loans. So therefore, because they're backed by the government, the risk is lower, right? And so the rates are going to be a little bit better, usually by about 0.5% better. In some cases, a little bit more, some cases, a little bit less. But the rates are going to be a little bit better on FHA.
Wow. Okay, guys, I'm taking the monthly payment breakdown off. I write this down. This is in my booklet if you meet me on the open house. A lot of people do not know what's in that monthly payment, and they wonder how it adds up to what it does and if it's low, if it's high. Again, your monthly payment is your homeowner's insurance. I always recommend, require, and even pay for the wind mitigation at the inspection time. Kind of jumping around. I'm talking about the payment, but I'm jumping to the inspection period. When you get an inspection on your house, get a wind mitigation. That wind mitigation can cut your homeowner's insurance in half, from $1,200 a year to $600 a year. And what's the savings on that? How much? What's the difference on that? 12 to 6, Stephen. What's the monthly difference savings? $50. I'll tell you, $50. Now I know I saw your brain. I saw your brain clicking, not clicking, but thinking. Okay. My sound booth person is saying something, sorry. The next thing is principal and interest. That's the principal, that's the interest, that's the bank. The next thing is the taxes, the county. You want to homestead that property because that's going to bring them taxes down, okay? The next thing is HOA, that's not always there. And that fifth thing that we've been talking about, and we're trying to ixnay on the PMI nay, is that PMI. We want to eliminate that, and that's going to give you a low payment. So bam, we just cut that out. We're going to go back to the loans. I didn't mean to get into the inspection period, but again, wind mitigation saves you money, and I do not let you forget that. I have a example here, Mr. Fennell. I don't know. Sound technical person? They're not paying attention. Let's see here. My assistant. Oh, there we go. Check it out. Okay. I have on the screen, you should see it here in a second, Stephen. I have the mortgagecalculator.org. I wonder who showed me that one. The guy to the right. I show everybody this, and they've never seen it. I've never seen it. Boom, there it is. You should be able to see it now, Stephen. Okay, we have a $300,000 house. Now, I messed up, and I put 5%. I should have put 10%. I put 5%. that needs to be changed to 10 because we're doing an example with and without PMI. I did a 4% interest rate. Stephen is normally better than 4%. The man does 3.4, 3.5, insane.
Twos.
Now, I'm going to jump off target here before we run out of time. Majority of the closings, every closing that's not at my title, well, that's when I'm working with the client. That's the seller picks the title company. They do the closing. The title company always says, "Man, this is a good rate. This is a good rate." And me and Steven, we hear that often. But I say, "Look, okay, hold on one second. Mr. and Mrs. Jones are buying a house. Can you emphasize on that? Because I want them to really know that Steven is a different. He goes above and beyond, and he finds that better rate." What do you mean? And the title company says, "We haven't seen a rate like this in 6 months, and 5 months, and 4 months." And those are the ones that are 3.4, 3.5. Even with a 580 credit score, he did a 4.4. So that's a big deal. People don't realize that. They see these ads where they're like, "We're going to pay all your closing costs. I'm going to pay it all. I'm going to pay all that," which is a lie because closing costs is homeowner's insurance and taxes, and they don't pay that. They just don't charge for the services, but that interest rate is almost 5%. 5%. I'm going to jump off target again. Just one more time. Stephen, how many times has this happened? I meet a client.
I would say probably, go ahead.
I meet a client. Amazing people. Because I only work for amazing people. Jeff, man, this lady, this lender, this guy, he knows me. He's, in my circle, my church, my grocery store, my softball league. He wanted to refinance my house. I wanted to get a pool. I don't want that. That's crazy. I want to buy a house with a pool. Okay, great. Let's get a second opinion. They talk to Steven. Steven says, "Okay, here's what I can do for you." Bam. Steven gives them a 3.6 interest rate. The interest rate, that other family friend, circle person, is 4.4. 4.4. And they're like, whoa, that's like $260 extra a month. I don't care who you are. You could be my dad. I'm not going to give you that much more money a month just because you're my dad. That's crazy, right? So, and they're like, this isn't real. This isn't real. So yeah, it's real. Okay, look, blah 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 blah. Steven's like, it's real. Let's go. They think about it. They go to bed. The partners, the wife and the husband get together. They do the blood pack. Hey man, we can't diss our friend. We're going to see her in the grocery store. We're going to see her in that softball. And what happens every single time, Stephen?
They diss their friend. They diss their friend.
Say that again?
They end up dissing their friend. They go with the lower rate.
No, well, no, not all the time. That person, not all the time. The other story.
Yeah. They'll go back.
One that you don't get the customer. Bad stories.
Well, what happens is they go back and they go, "Well, can I get a better rate? Because this is what I've been offered." And their other lender goes, "Well, I can take you here." They take them down a little bit, but they still don't get as low.
This is what they do. They're like, oh my God, there has to be a mistake. Let me call God and I'll call you right back. God, I need to lower this rate. I'm fixing to lose my friend, softball family. Can I lower it? Yeah, of course. I don't know why you're calling me. Okay. Client, guess what? I can match that rate. The messed up thing about that is, I see this all the time. It took Steven, no one's calling you saying, "Steven, match this," because you're the lowest one. It took Steven giving them a better rate. And the point I'm trying to get at is you want to do more research. You want to just don't talk to one person. Nothing against that person, but there's more options out there. Just like you were saying earlier, that not all the lenders know about getting rid of the PMI. So it takes Steven and they got a better rate, and the fee was still a little higher because Steven's fees are lower, and they went with that person. But it took Steven to get that person to give him a better rate. And that person went to closing, and I called him out on it. And they had nothing to say. Nothing to say. They said, "I called God, and God said I can do it." And I said, Amen.
It's like the old, when you go buy a car, "Well, let me get with my sales manager."
Yeah, oh my God! Oh shoot! Oh, It's not me. I can't make that decision. I got to go ask someone else.
Right.
Dog in the backyard and ask the dog. Okay, so this example that I'm showing you does not have PMI. 300,000 taxes are 3,000. The homeowner's insurance is 700. If you're paying more than $700 a year for your homeowner's insurance, you need to do a wind mitigation. You can get the same homeowner's insurance for $700 a year with the wind mitigation. Here's how much that here's how much that payment. That payment without the PMI is $1,668 a year. You're like, whoa, stop the truck. Stop the truck. I can get a payment for $1,668 for a $300,000 loan? Yes. Right?
Yeah.
Do that.
Absolutely, you can do it.
That's lower than mine, and my loan is a lot less. That's
Yeah, why not?
My payment is more than that. My taxes are the same, but my payment's more, and my loan is less. My loan is like $250, and this is at $300. Okay, the reason why that is because there's no PMI. If you look at the top, it says 1668. If you want any of this information, message, put it in the message. I'll have it up there. Here's another scenario. This is with PMI. Same scenario, 300,000, 5% down, 4% interest rate. I'm just going off of an average. If you're not getting a 4% interest rate, you need to talk to me and Stephen. If you're getting 4.5, 4.6, especially if you have a 700 credit score, and you're not getting into the threes right now, you need to talk to me and Stephen, mainly Stephen. Talk to me and then I'll introduce you. If you don't want to talk to him directly, you need to. Stephen, guess how much his payment is? I'm showing you right now. That's the same thing, but with PMI. Guess how much it is?
How much?
I don't know. I'm trying to hit the button. Where's my technical person? Oh, what am I? It is. Nope, that's not it. It is. Let's see here. It is. Maybe it's behind there. There it is. Okay, $1,870. That same loan with PMI is $1,870. So that's where I got that $200 from.
It's $200 a month, buddy.
What is that a year? $2,400 a year.
Mm-hmm.
Where does that
go? What is that over 30 years, right?
Who's getting that money? That's what I want to know. Like, what game are they in? Like, who's getting paid? Who's getting that government? Like, who's getting that money?
Well, you know what it is that, we as banks make money off of interest, right? Some of us may charge fees, some of us may not, but we make money off interest. So, a lot of times the loan officer gets paid the difference, by charging up that interest rate. And so, our mentality is at Fountain is, listen, we want to offer a good rate. We want to be fair. We want to do a really good job. And many banks are like that as well. And we don't necessarily need to be greedy, right? We don't need to be greedy because we know if we offer good rates and we do a good job, the realtor, yourself, and other buyers will refer other people to us. So, we, like other good banks out there, we have a long-term view, right? Some other banks have a short-term view. They want to charge you as much interest rate as they possibly can and profit off that. And then the other ones also have high overhead, right? They have a lot of overhead, so they got to charge higher interest rates.
Oh, they're
That's how it works. Yeah.
You said two things. I want to talk about one thing you said, another thing that no one really knows about. And this whole podcast and this whole show is just to shed light on just facts that people don't know of until they run into it or they might not ask. You said they charge a higher interest rate and they get paid, the lenders get paid the rest of the, say that again? Are they making money off of it?
Banks get paid off of interest rates. So you have some lenders, some loan officers that get paid by charging higher interest rates.
Oh, they get like a bonus commission.
We get a commission. Some of us get commission by charging higher interest rates. So the difference sometimes between what I may charge and what someone else may charge is what that loan officer may be making.
So the people that we meet that have the friend at the birthday party, the church, the grocery store, the neighborhood, they get that rate and it's higher than the rate that you give them. They're probably getting paid commission off of that. So they're like, hey, I know you're a friend. I know you're in my circle, but I want to get paid I want to get paid.
Right, which is why when sometimes I'll come back when beat their rate, they'll all dramatically all of a sudden be able to lower that rate, right? Because
Lowering their commission.
they'll just lower their commission, exactly.
Hey, you know what? I forgot how good friends we are. You gave me that beer. You let me loan the tool.
You're getting ready to leave and go to another bank.
Oh, you're moving away from me. I don't have
Yeah.
to see you anymore. I'll discount my commission.
Yeah.
That's not cool, man. That is not cool. I did not know. I mean, I had an idea, but I didn't really know that it was like that. The higher the rate, the more you get on your check. The lower the rate. That's not right. I mean, that like it gives that man. Does a lot of banks do that still? I know that was maybe before the boom where we had the adjustable rates. There was a lot of bonuses off of what the rate could go up to because they didn't know that it was going to go up there because they're like, oh, just refinance it. It won't go up there. But the lenders knew that it was going to go up there.
Yeah, and I'll tell you another interesting thing is that typically when someone says the rates are going to go up, the Fed is going to raise the rates. So the Fed says, hey, they come out and say we're probably going to raise the rates July 31st. So some people sit back and think, well, we'll just wait until they raise or lower the rates on July 31st. Well, the market is smarter than the news, right? So it always is happening in the market before it comes out in the news, right? Always, 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 always. So you hear, like stockbrokers will tell you, you buy on the rumor, you sell on the news. By the time it hits the news, it's already priced in, right? So if the Fed says they're going to lower rates between now and July 31st, the market is already adjusting for what they anticipate that's going to happen and occur. Because most inside bankers already know what the Fed's going to do. They already know. It's just a matter of when they announce it. So the market starts adjusting its pricing and the rates start going down, so they may be going down now in anticipation for the announcement. So when the announcement comes out, everyone thinks it's going to dramatically drop, and it doesn't. And that's because it's been priced in gradually between now and the end of the month. So that's something that happens, that people don't realize that it's happening. The market adjusts for itself along the way.
Wow, I didn't realize that. So when it comes out, the rate's already lowered.
It's already adjusted, yeah.
It's a good chance that it's already adjusted. You might as
Or
well.
increased. Yeah, or increased, right? If they think that they're going to raise the rates, it starts raising in anticipation of that announcement that happens in 2 weeks. The rates already start going up. Bankers are already starting to make money on the prospect of what's going to happen or what's going to occur. They don't wait to the day of.
Wow. Okay. Next thing. A lot of people don't. Some people do. I don't hear it as much as I used to. Maybe it's because I say it. But when they have a lender, I feel that they don't ask enough questions about how much are you charging me? What is your origination fee? Lenders have a lot of different words, what they call they're charging you. Closing costs, we talked about this at another episode, we'll do it again, but closing costs for a buyer, not a seller, a buyer, is going to have the money that the lender is making. Before the economy went down, it was like 2%. The lender was charging 2%, and then the majority of your closing costs is supposed to be not the lender's fee. Your closing cost is your homeowner's insurance, a year and 3 months, your taxes, a year and 3 months, your transfer taxes, that your taxes on, like you're buying it, you have to pay taxes, not the yearly taxes, because you're more than likely going to receive a credit because you pay that at the end of the year, but the actual taxes, and then your title fee. Your closing cost is not all money going towards the lender. Stephen's cost starts at $950. I say starts because if you want to buy that PMI out or buy down the interest rate, then we need to do, that's when it's going to cost some more money. But a lot of other lenders, they start at like $1,500, and on top of that, they charge half a point. I don't know why. I don't know. Maybe they do it until you say something. Like, I know every bank has it different, but talk a little bit more about what you've seen and what I know this isn't the only bank you've worked at, even though they probably have a fountain named after you or two in Kansas City. But
Fennell Fountainiera.
Yeah, whatever. Yeah, that's probably a garden hose you turn on.
Yeah.
The fountain's the sprinkler one in their yard. That's what it is.
No, no. So the closing costs are. It's a great thing you pointed out, Jeff, because sometimes banks will just quote a rate. What is your rate? Oh, I can give you a 3.5 or a 3.0 or whatever, and the person will take that and they'll run to the bank with it, and then they'll get the paperwork, and they may or may not look to see what the lender charges are, or if there are loan origination charges that are spiked up, how high they are. Some banks will hide their discount points in the origination or the bank fees, right? So instead of being 950, it might be 2550, and they'll say, well, you get this great rate, and they won't even think about the fact that they're being charged for that. So that's why APR is very important, because the APR, the annual percentage rate, will identify if there's any extra fees or fees that are spiking the interest rate to where it's at, right? So a person should always pay attention to their APR. The rate might be at 3.5, but the APR could be at 5.2. Well, that gap is telling you that there's a charge somewhere that you're probably paying for that you don't know. And you should at least have the discussion as to what's causing the variance between the APR and the interest rate.
APR isn't APR interest rate. Say that again. Interest rate and APR annual.
Yeah, your annual percentage rate. So what that is that's taking into account all of the other charges that you may or may not take care of at closing, right? For example, origination fees, you're going to take care of that at closing, right? Mortgage insurance premium, you're not going to take care of that at closing if it's an FHA loan. Points, you're probably going to take care of it. But it still factors in all of those charges as if they were done over the life of the loan of 30 years. And if they were, here's what the rate would be. Okay?
Like your escrow?
Escrow? Yes. Yeah.
Okay, so I know what you're talking about.
Mm-hmm.
This number that you're talking about is on like the last page of the closing disclosure.
That's right.
In this little section, I wish I had a picture. And in this section where it says that, it also tells you how much interest you're paying over the life of the loan. On a $300,000 loan with a 4% interest rate, you are probably, we'll just make it easy, you're paying $250,000 in interest. So the total loan amount over 30 years, what's 250 plus 300? $550,000.
It's a big number. It's a big number. I was looking to see if I had, I don't think I have a sample to show you. I wanted to show you what it looked like, but I don't think I have it. Let me just check one other place.
Yeah.
I'll show you that last page, but I don't think I have it. I don't have one with me right here.
Another frustrating thing that a lot of title companies point this out, they don't always go over it. I do, because I want the homeowner to know you need to pay off that interest. You need to make extra payments. Be disciplined. You don't want to pay $250 in interest. Nobody tells you that when you go get the loan. They're like, oh, they think 4% times the loan, blah, blah, blah. No, it's an average daily balance. And there's only this little tiny section on the page, and it says total interest paid, total monthly payments with the interest. So even though your house value has gone up, you're still not making any money. Still not making any money. And then below that it says annual percentage rate, and it's always higher because it has all that. But you're saying if it's really high, that means that they bought it down. Yours always is like if you have a 3.6 interest rate on that page, it might say 3.8. Yours never really is that big of a difference.
Yeah, if you have a huge variance in your interest rate versus your APR, you should at least start asking the questions, what is the driver for that variance? Why is there such a disparity? Because that means you're paying somewhere along the lines, maybe some fees that you may not be aware of or were not communicated verbally. They have to put it in writing, but that doesn't mean that everyone reads those thoroughly. So it should have verbally been communicated up front as well as in writing. So you should ask it if there's a variance in your APR versus your normal interest rate.
Great. All right, Stephen, I think that's it, man. We're at our time. Great show. We can really talk about lending every day. There's just so much to it, and I feel that people, they get overwhelmed with it. I know I did. And if I would have known what I know now, and I was my own realtor, right, I should have hired one. Or I should have used a better lender, knock on wood. No offense to the one I did, but I'm paying PMI, and my payment's high. Well, not high, but I have a good rate, but I'm paying PMI. The frustrating thing about it, Stephen, is I could have bought down the rate or I could have bought out the PMI because I had more money to spend. And I didn't know that. That's the thing I don't want my clients to go through. You're like, man, if I would have known this, I would have did that. And I don't want that. I don't want that to go. My sound person's making all this noise over here. It sounds like a child or something. But that's the point of the show, man.
Absolutely. No, I appreciate you bringing me on and letting me speak to that. We've done a number of deals together where we have illuminated, I love that word you came up with, illuminated the buyers with the prospect of eliminating PMI. So now they start coming to me and saying, Jeff said that you have a way to illuminate the PMI.
Yes. Because you don't know until you try. Not everybody can. But that's you want the best. You're like, what's the best loan, right? And no one really talks about that either. What's the best gig? They talk about what's the best computer to buy. What's the best interest rate? But they don't talk about what's the best loan to get that interest rate.
Yeah.
And another thing is that monthly payment. Just a quick recap. It's not about the loan amount. It is, but it's about the monthly payment that you want to spend. And you want to think about that. You don't want to think about 300, 400, 500. You want to think about how much money do I want to spend a month? And then we find a house and we look at houses in that amount. And 9 times out of 10, they want a nicer house than what they want to pay or what they can pay. And then we have to get creative, like what we're doing. And we're like, if we eliminate the PMI, we can have an extra $200 to $300 go towards the principal and interest. And what does that do, Stephen? What does that get us?
Gives you the ability to buy more house. Yep. Well, that's interesting. You've done that a number of times. And it all starts with the discussions we have around what your comfort zone is on the payment. All around that discussion. It's like, well, I think I want a $200,000 house. I can't tell you how many times you've walked away with selling them a $300,000 house that they love, that they never would have known they could have afforded it unless we've had that discussion on their comfort zone.
That's a big deal. And that's what I try to do. Okay, guys, the name of the live show, podcast, Facebook, Instagram, Twitter, whatever the other stuff is, Jeff of All Trades. It's called that because I feel like I've worked every job out there. But I know a lot of stuff about a lot. I know a little about a lot. Stephen knows a lot about a little, which is lending. I know a lot about a little, which is real estate. But I know a lot about a lot, which is Jeff of All Trades. Don't ask me to say that again.
Jeff, keep in mind that we work realtor hours. So, you guys work all the time. So, we work realtor hours. We want to make sure we're available because that's when you need someone to be there as a strategic partner. So weekends, evening hours, whatever, 7 days a week, holidays, we work realtor hours.
Just like you coming on the podcast. It is 7 o'clock Eastern Standard, 6 o'clock, whatever time zone before it's Eastern Standard. And you're doing this to help others. So that's what shows it, and that's what I try to show, and that's what I do. Because in the long run, it's gonna help that one person get that good deal. And that's why we do this. That really is.
I would just like to say thank you for allowing me to be a part of the Jeff of All Trades podcast. Pleasure being a part of it and always talking with your audience. You can reach me on Facebook, Stephen Fennell, 4A Home Loans. You can also reach me on the web at the number 4, the letter A, home.loan. You can reach me at Fountain Mortgage on the Fountain Mortgage website, Fountain Mortgage. We're in Kansas City. Actually, we're in Prairie Village, Kansas, but Kansas City is the metro. And you can find me on Twitter.
And go to some of them fountains in Kansas City, your name and number will be on there too.
Once I've had the opportunity to visit them all.
Okay, guys, thank you so much. Next week, I have exciting, big, game-changing for me news to break. And I've been holding it in for a long time. That sounds kind of weird, and I'm going to tell everybody next week. So stay tuned. Again, questions, I'm here. I'm here to help, chit-chat, tell me what's going on, and I'll solve that problem. Jeff of All Trades, thank you, Stephen. Have a good night, and we're out.